Hello everyone, in this video, I will be sharing on the basic methods to analyze a fundamental of a stock to combine with stage analysis so we can optimize our gain in stock market. I will be using Google as example here, as this is one of my favorite stocks and I'm confident that Google or Alphabet is a stock that can consistently generate nice return for the coming 5 to 10 years. To make the fundamental part as simple as we can, I have selected 5 most important criteria. First, to generate consistent and increasing revenue and net profit over past 3 to 5 years. We need a company that can keep making profit. Then it will reward us with either rising stock price or pay us dividend. I found a very good website to screen for the financial data. Click on it, search Google, then select financial. We will be able to select the financial data that we want to plot. I will be focusing on the annual value. Look at the revenue of Google. It is clearly an uptrend. It generates more and more revenue over years. Google also generates consistent and increasing profit over years. There was a dip in year 2017, but overall, Google is a company that makes money. Another important criteria to look for is share buyback. When a company manages to make consistent profit, they will be able to buy back the share, reduce the numbers of shares in the market. Here is how it works. Whenever there is demand for a company's shares, the price of the stock rises. When a company buys its own share, is helping to decrease supply. Price increases, more buyers are willing to buy it, further increase the demand, thereby creating value for all shareholders. We can simply use Google to search stock plus share buyback to check if the company did buy back the share. Using Alphabet as an example, it announces 70 billion buyback in April 2022. Second, moat or gross income margin. A company with a strong moat is important to ensure the company has competitive advantages that protect it from rivals and enable its large profit. It does not need to worry about the price war and they can just increase the price to cope with inflation. Google has a huge user database and there's enough for it to maintain its strong moat for digital marketing. One of the ways to measure moat is gross income margin or gross profit ratio. In general, a gross profit ratio of more than 25% is considered healthy. For Alphabet, the gross profit ratio is as high as 60%. From this chart, the Alphabet managed to maintain its gross profit ratio for at least 20 years. To generate consistent and increasing cash flow of operation. Cash flow of operation is very important. It indicates the amount of money a company brings in from its ongoing regular core business activities, such as advertisement business for Alphabet. When a company shows a reduced or negative cash flow of operation, even the revenue and net profit are increasing, it is not sustainable, as the company is not generating the money through its core business. This is the chart of the Alphabet on cash provided by operating activities. It is a clear uptrend, means Alphabet managed to generate consistent and increasing cash flow through its core business. Health debt profile, current ratio and debt to equity ratio. Next, a company with a strong fundamental must have a healthy debt profile to ensure the company can sustain during the winter time. A good current ratio is between 1.2 to 2, which means that the business has 2 times more current assets than liabilities to cover its debts. A current ratio below 1 means that the company does not have enough liquid assets to cover its short-term liabilities. The debt to equity ratio is used to evaluate a company's financial leverage and is calculated by dividing a company's total liability by its shareholders' equity. Although the debt to equity ratio varies from industry to industry, I prefer a company with a ratio of lower than 0.75. We can obtain both current ratio and debt to equity ratio from Finwip. For Alphabet, the current ratio is 2.8 and debt to equity ratio is 0.06. Alphabet has a very healthy debt profile. ROE, return on equity, provides us with an insight into the business profitability for owners and investors. In short, it helps investors understand whether they are getting a good return on their money. To me, a good company should have an ROE of at least 15%. We can also obtain ROE value from the Finwip. Alphabet has a ROE of 28.6%. Summary: Alphabet, increasing of revenue and net income in the past 5 to 10 years. Strong moat with gross profit margin of 60%. Increasing of cash flow from operating activity in the past 5 to 10 years. Healthy debt profile, high ROE. Thus, once the Google is showing a positive signal in stage analysis, I will not hesitate to add more in my portfolio. That is all for my video today. Do you have any stocks that would like me to analyze the fundamental? Please comment below and I will be happy to analyze it. Before you go, please give me a like to motivate me. Thank you and see you in the next video.